a check right now in the energy markets. We want to bring in Jeff Currie. He is a Goldman Sachs partner alum who is now advisory board chair of the University of Chicago's Energy Policy Institute. And Jeff, good morning. Thank you for joining us, and congratulations on the new gig.
Well, it's a board seat. I'm also on BOR and ABEX as board seats. And the new gig is likely to come sometime in the near future, but right now it's board seats.
Okay, well, Jeff, let's talk about your outlook for commodities markets. You're pretty bullish on all of these commodities this year. You were pretty bullish last year, and it didn't quite play out that way, at least when it came to oil. So what happened last year, and why do you still believe in the super cycle?
Well, let's go and let's look at this quote-unquote immaculate disinflation. I want to point out a couple of facts. One, it's happened globally at the exact same time. So it's globally synchronous disinflation. Second point is commodity demand, oil demand, coal demand, copper demand at record level, U.S. economy booming. So what does that tell you? It has to be supply driven, not demand driven. Therefore, it can't be monetary policy. It cannot be fiscal policy. What it is regulatory easing. You know, politicians turned a blind eye on the sanctions in places like China. That led to 1 million barrels per day plus of additional oil from Iran, Venezuela, Russia. Then the secondary sanctions, debottleneck supply chains, more fertilizers, more wheat, so more energy, more food. And this all put downward pressure on oil and commodity prices. So then the second point is we saw the world last year turn a blind eye to environmental policy. They did it in about face. Whether, record oil consumption, record coal consumption, deforestation, cutting down mangroves for palm oil, deforestation for soy. So you got more food out of it. So when I think about what happened here, we overestimated the willingness of politics and politicians in the West to pursue their political goals, being deglobalization, decarbonization, as well as redistribution policies.
Hey,
and
Jeff,
because of that, we ended up with more supply.
Well, let me just say on that front, though, politicians did what they needed to do, I think, for their ultimate goal, which is to stay elected, get reelected. When prices spiked and consumers said, we're not paying for this, they did turn a blind eye because they figured the most important thing is that you don't have consumers mad that they're paying so much at the pump, mad that they're paying so much at the grocery store. So they said, OK, whatever is going to get more food and energy to the table or into your pump more cheaply, they're going to go ahead with it. What makes you think they're going to change their minds this year?
By the way, the view I take, as soon as you have inflation coming back down, everybody's happy again, they're going to turn green again. And then look at the implications of allowing Iran to pump an extra, 8,000 barrels per day. They have the Houthis taking, shots at U.S. warships in the Red Sea. So there's a cost to this. So as soon as the inflation settles, more likely than not, you're probably going to see a flip once again. We may not go all the way back, but we're likely to see everybody become more green and more focused on some of these sanction issues. But right now, it debottlenecked the system, created excess supply, and put downward pressure on commodities. So that's why I would argue, I'm not going to point the finger or anything like that, but that's really at the core why we were so wrong last year. You just got a lot more supply, political oil, carbon-based commodities. You got a lot more of those last year than what we thought you would get. And I don't think we were alone in those assumptions over a year ago.
Sure.
So I think the big question going forward is okay, what does the outlook look like going forward? And I'd say there's 3 points I want to emphasize there.
Can I just ask before we look for the outlook going forward? I mean, wouldn't that always be the case, that there's always going to be, if what played out last year is politicians saying there's the limit to what we can expect consumers to pay? Wouldn't that always put a bit of a ceiling on commodities prices? So the idea of a real super spike kind of gets out of the way because politicians everywhere are going to do everything they can to keep that from truly happening.
Well, let's go back to like 07, 08. You had the super spike occur there, but it didn't filter into broader inflation. And what got policymakers so focused on commodities this time around is it filtered into the broader inflation mix.
Jeff, I think you're beating yourself up a little bit too much here, because if 73 is the bottom of the cycle, that's not too bad for being bullish on oil prices, because I remember 48 and I remember 10. I was a reporter at the Journal when it was $10 a barrel. If 73 is the bottom...
I remember zero from 2020.
Yeah. Zero. Well, forget zero.
Yeah, there
zero
was. I remember it was negative back in April of 21.
But I mean, I never was sort of on the super cycle train, but the idea that 73 being the bottom is not too shabby if you're bullish this commodity.
And by the way, it is the most investable space out there in the economy right now. The return on capital employed exceeds 20% in many parts of the world. Go back to your point, if this is the low point, and we're underinvested going forward. Back to answer your question, is this a common occurrence? I think the problem is like the boiling frog. It happened too quick, too fast, went up too high, hit the consumer, and the backlash from governments around the world was significant. I mean, I live here in the UK, and they did an about face on their green policy. I think we'll see the green policy resurface and become an important driver. By the way, we'll talk about China in a second. The green policy is full steam ahead there, but it just did it a little bit at the margin. It wasn't substantial, but it did take some of the sting out of the markets. And I think, as Steve points out, 73 is not a bad price.